But the funny thing is the Federal Reserve has about $1 trillion worth of unrealized losses while operating at a loss. So it's actually in if it were a bank, it would be bankrupt. But because of just its own operating thing, it's still able to operate, and it just kind of shows the crazy times that we're in.
Lyn Alden, founder of Lyn Alden Investment Strategies, explains that commercial banks and central banks work similarly in terms of assets and liabilities, with the latter earning a spread on their holdings. She goes on to explain how the Federal Reserve is different because all physical currency is its direct liability, and banknotes are issued by the Fed. She explains how the Fed stores cash from banks and earns interest on it, and its asset side is mainly longer duration assets like treasuries and mortgage-backed securities. For decades, the Fed's asset side paid a higher average yield than its liability side, which allowed it to operate at a profit and remain independent. Lyn points out that the current cycle is different because, for the first time in modern history, the Fed's liabilities are higher yielding than its assets, resulting in a loss. The main difference between the Fed and commercial banks is that nobody can do a direct run on the Federal Reserve, so they are not prone to the same types of things as commercial banks. However, the Fed has about $1 trillion worth of unrealized losses, and if it were a bank, it would be bankrupt. Let's hear Lyn give us more insight into this. Before we get into the video, please like, subscribe, and leave your comments in the box below, as this helps our small channel grow.
This article, and when people think of banks, the funny thing is that central banks actually work pretty similarly. They just have a few extremely important differences. So a normal commercial bank, you have assets and liabilities. And in an ideal scenario, the assets are higher yielding than the liabilities, so that the bank is earning a spread, right? So for example, deposits are lower yielding than mortgage loans in most cases. And so the bank is able to make a spread. A central bank works very similarly. So, they one is all physical currency is a direct liability of that country's central bank in the current era. There were periods of time like in free bank history where banknotes would be issued by a specific commercial bank, but in the modern era, most banknotes are issued by central banks. So, dollars are liabilities of the Fed. Also, banks store their cash at the Fed, and they earn interest on it. So that those are bank reserves. And then there's also reverse repos, which is a little bit more complicated. But the point is they're also a liability of the Fed and they pay interest. So the Fed has these liability sides, and then their asset sides is mainly longer duration assets. So they own treasuries and mortgage-backed securities, and those make up the majority of Fed assets. And for many, many decades, far longer than both of our lifetimes, the Fed's asset side pay a higher average yield than their liability side because banknotes pay zero. Bank reserves historically didn't pay much, whereas the Fed's holding of treasuries and more recently mortgage-backed securities, pay a positive yield, and so the Fed operates at a profit, and that's partially what gives it independence. It's not given funding like a government agency like NASA, for example. It has its own funding source, and in fact, it by law it has to give its excess profits to the Treasury. So it's actually been a profit source for the federal government, and many central banks around the world kind of work similarly. And what made this cycle different is that because they raised interest rates so sharply from the zero bound, for the first time in modern history, the Fed's liabilities are higher yielding than their assets. So, what they pay on reserves and what they pay on reverse repos is, they're paying out more interest than they're getting on their very low yielding treasuries and mortgage-backed securities. So they're operating at a loss. They're no longer paying money to the treasury. And I think moreover, it shows what other banks would look like if they were to raise their deposit rates to the level we see in money markets and T-bills. If you were to see banks around the country raise their interest rates to 3, 4, 5%, many of them would have a similar operating loss and start eating into their capital like the Federal Reserve has. The main difference between the Fed and a commercial bank is that nobody can do a direct run on the Federal Reserve. So they're not prone to the same types of things that Silicon Valley Bank was. But the funny thing is the Federal Reserve has about $1 trillion worth of unrealized losses while operating at a loss. So it's actually in if it were a bank, it would be bankrupt. But because of just its own operating thing, it's still able to operate, and it just kind of shows the crazy times that we're in.
You did right. They could keep functioning at a loss indefinitely, at least on paper. It's an accounting gimmick. I'm going to spoil the movie for the audience here. You did write your conclusion, a rather anticlimactic conclusion. So you're projecting the tangible equity to turn negative later in 2023, and you wrote, "What happens when the Federal Reserve's tangible equity turns negative later in 2023?" You wrote nothing, at least not immediately. Can you expand on that for us?
Sure, and as an update, since the article was written, now tangible equity actually has turned negative. So the Fed has, there's two ways to measure it. I mean, one is that, even not marking their assets to market, they now have tangible negative equity. But then if you actually mark their unrealized losses to market, they actually have $1 trillion or so in negative equity. And so again, if they were a bank, they'd be bankrupt. But because the Federal Reserve is different, they're able to, kind of record their losses almost like an asset. They're like, okay, we have this many accumulated losses. And in the future, should we ever turn profitable again, instead of paying our excess profits to the treasury, we get to pay ourselves back first. We get to dig ourselves out of this hole. Like imagine if you were running on a profitable business and instead of facing the consequences, you can say, well, one day I'll be profitable in the future. So I'll just, I'll add that as though I made that profit now. That's kind of what the Fed's doing.
Well, one of the functions of the Federal Reserve, like any central bank, or most central banks rather, is to function as the lender of last resort, which is to say that if a financial institution of relative importance were on the brink of collapse, and its collapse would greatly affect the economy, the Federal Reserve would have to step in and provide liquidity and credit. Is the Federal Reserve in a financial position to provide such liquidity to all the major financial banks if supposed hypothetically all the banks, all the big ones at least, were to go bankrupt overnight and had to have money from the Fed?
So in the modern era, the Federal Reserve doesn't hold reserve, it creates reserves. So by
Oh, that's
definition,
convenient.
it's always in a position able to provide reserves. So yeah, it's never in a case where they say we literally don't have money, we can't do it. Now, obviously, there's still a constraint, and the constraint is inflation. And if the Fed is unable to maintain tight monetary policy while you have above target inflation, then they risk getting longer term runaway inflation. And so I actually think that's going to be a recurring issue this decade. I think that's the big theme is that because of how much debt's in the system, they're going to be unable to get to a period of structurally positive real yields. And they're unable to get to a place where they can get their balance sheet down to a normal size. And so I think you're going to see ongoing deficit monetization. Now, there's periods of time where they might not do it, like the past year, for example. They cease deficit monetization. They reverse course for a period of time. So that not every month, every year, they're necessarily doing it. But I think the general trend is that they're essentially stuck. And again, I mean, they always have the capability to bail out any individual bank. They can never run out of dollars, but they can devalue the purchasing power of those dollars.
Right, right. I guess they can also devalue the debt, but that's another story. So the Federal Reserve, I noticed that their central bank balance sheet has recently spiked up. What does that do to?
That's due to loans. And so basically they now have facilities. So if the bank runs had continued, right? So a lot of these banks have unrealized losses. They're in a similar position to the Fed where they bought these treasuries and mortgage-backed securities back when they were lower yielding, and now they're much higher yielding, which means their prices are way lower. Now, normally that's not a problem because those are nearly risk-free. When they mature, they can get all their money back, and banks are allowed to hold those to maturity and not have to worry about those losses. Now, the problem is if they have a bank run for any reason, if deposits pull out, maybe they pull out quickly because they're worried about the bank solvency, or maybe they pull out slowly because they want to go get higher yields in money markets or another bank, then that bank has to sell those securities. And so those things that they expected to hold to maturity are now being sold at a loss. And that can destroy the bank, and that can also, make some depositors not get their money back, and it creates like a vicious problem. It also can break those securities markets. If a bunch of banks are selling treasuries at the same time, the treasury market can go illiquid, similar to how it did in say September 2022, or even worse in March 2020. You can get these illiquid, volatile treasury markets. And so what the Federal Reserve did is they opened a facility after Silicon Valley Bank failed. And they said, okay, if you have a bank run, then instead of selling your securities, you can use them as collateral at face value to get a loan from the Fed. And so even though on one hand they're still pulling liquidity out by doing quantitative tightening, these loans represent a injection of liquidity back into the system. And so you've had 2 weeks of very large up moves in the Federal Reserve's asset side, and now 1 week of mild contraction. And I think it's probably going to trend sideways for a period of time until there's a more severe issue.
What are your thoughts on the Fed's unrealized losses? Why do you think the Federal Reserve is not prone to the same types of regulations as commercial banks? Let us know in the comments below. Thanks for watching.